Hedging is a risk management strategy designed to reduce or eliminate the uncertainty associated with adverse price movements in financial assets, commodities, interest rates, or currencies. Futures contracts are among the most widely used hedging instruments because they allow market participants to lock in prices today for transactions occurring in the future. A hedge can protect against falling asset prices, rising costs, or market volatility. The primary objective of hedging is not to maximize profits but to stabilize future cash flows and reduce financial uncertainty. The program emphasizes that effective hedging enables firms and investors to focus on operational objectives while minimizing exposure to unfavorable market conditions. Hedging strategies are generally classified as either short hedges or long hedges. A short hedge involves selling futures contracts to protect against declining prices in an existing long position. For example, a farmer expecting to sell crops in the future may short futures contracts to lock in a selling price and reduce exposure to falling commodity prices. A long hedge involves purchasing futures contracts to protect against rising prices for assets that will need to be acquired later. Airlines, for instance, may use long hedges in fuel markets to secure future fuel costs. Both approaches aim to reduce uncertainty, although hedging may also limit the ability to benefit from favorable market movements. An important concept in hedging is basis risk, which refers to the risk that the relationship between the spot price of the hedged asset and the futures price changes unexpectedly during the hedge period. Basis risk exists because the futures contract may not perfectly match the asset being hedged in terms of quality, maturity, or delivery location. A perfect hedge occurs only when the futures contract and the underlying exposure move identically. Cross-hedging may be used when no exact futures contract exists, requiring a related but different asset to serve as the hedge instrument. The effectiveness of a hedge depends heavily on how closely the futures contract tracks the value of the underlying exposure. Stock index futures are widely used to hedge equity portfolios against market risk. Portfolio managers may take short positions in stock index futures to protect against anticipated declines in overall market values. Because stock index futures are based on diversified indices, they provide efficient and cost-effective protection for broad equity exposures. The number of futures contracts required for a hedge depends on the value of the portfolio beta, the value of the futures contract, and the target level of market exposure. By adjusting futures positions, portfolio managers can either fully eliminate market risk or alter portfolio beta to achieve desired investment objectives while maintaining underlying stock holdings. The effectiveness of stock index futures hedging depends on several assumptions and limitations. Traditional duration and beta-based hedge calculations assume relatively stable correlations between portfolio returns and index futures prices. However, large market movements, changing correlations, or non-parallel shifts in market factors may reduce hedge effectiveness. Rollover risk may also arise when hedging horizons exceed futures contract maturities, requiring traders to close expiring contracts and establish new positions. Liquidity conditions, transaction costs, and imperfect matching between portfolio composition and the chosen index can also affect results. Consequently, hedging strategies require continuous monitoring and adjustment to ensure that risk reduction objectives are achieved under changing market conditions. The program highlights hedging with futures as a fundamental application of derivatives in financial risk management. Futures-based hedging allows corporations, institutional investors, banks, and asset managers to stabilize cash flows, reduce portfolio volatility, and manage systematic risk exposures efficiently. Although hedging cannot eliminate all risks, it significantly reduces uncertainty and enhances financial planning capabilities. Effective hedging requires understanding hedge ratios, basis risk, contract specifications, and market dynamics. Stock index futures, in particular, have become indispensable tools for portfolio management because they provide liquidity, flexibility, and cost efficiency. Mastery of hedging principles is therefore essential for risk professionals responsible for protecting institutions against adverse financial market movements.